Today, you asked, we answered. Hello again, it's Martin North from Digital Finance Analytics, Web Notice Post, covering finance and prop news with a distinctively Australian flavour. Today I'm joined by Tarric Brooker, and we're going to do a Q&A today, Tarric. Hi.
Yeah, well, it's been, we've had a few sort of semi Q&A shows before, but, we've got quite a few questions to get through, and I'm looking forward to giving you all some answers.
And what's interesting, I thought the questions actually were actually very, very penetrating questions. So, there are a lot of people who are following, certainly you, Tarric, and maybe me a bit, are actually asking the beyond the obvious questions.
Yeah, definitely. I think that our audiences are generally a very switched on group of people, and they see things that things are a lot more complicated than the sort of traditional narratives and the mainstream stuff would suggest, because, well, it is. There's always those things going on behind the scenes that could end up deciding things a lot more than some of the more prominent stuff.
Yeah, and I do think that's an important point, because, of course, there is an intent in some cases to try and simplify the billio out of everything, to make it simple and straightforward that you can explain in, a 30-second short. But actually, life isn't like that.
No, it's generally quite a little bit more complex. And while I think if you have the skill and the knowledge and the know-how, you can give a pretty comprehensive answer in 30 seconds. If you really want to get into the nitty-gritty of things, if you really want to, as you say, go granular on some of these things where you really do need to go granular, you do need to take a little bit longer. And, I think today will be a good opportunity for that, because, both of us are here, and I assume we're both going to have we're going to have different views, and that should be interesting.
Hopefully it will be. Well, let's get going. And what I quite like, of course, is that you always start with a cartoon, and we're going to do that again today. And this is a brilliant one.
yeah, it's all about the height of the Fed share. That's what that determines absolutely everything, apparently. And so I've put together a few charts to basically go along with this. So, just to give you all a bit of a visual aid when I'm talking about some of the data points that we've gone through here. And basically, what I've done is I asked a bunch of people on Twitter as to their questions. And I'll be just reading through these people's questions. I put them together when they've been relatively similar, and we can cover them with a bit of a chart and a little bit of extra data. But yeah, so if you like this type of format, if you would like to, ask questions and have them answered and stuff like that, and that's something that you would prefer, or in addition to the normal chart show, just let us know. And as usual, the charts will be available at avidcom.substack.com, and I'll get Martin to put a link in the description, and any support you provide will be greatly appreciated. So I'll get to the first question.
Yeah, great, Tarric. And I will just say that you are definitely veering more and more towards coming onto one of my live streams and taking questions live. You want to be careful.
Yeah, I don't want to raise the expectations too high. Okay, we got two questions here about property, which are a little bit similar. One from Common Ground, who asks, given that we're not really seeing any panic yet about price declines on housing, do you think that gives the RBA more headroom to keep rates around this level? And YSL Fund asks, when do you think Sydney housing prices will finally burst? Still outrageously high. So just before we answer this question, I'm just going to bring up a chart of Aussie housing prices. And Martin, would you like to go first?
Yeah, sure. So I think panic is relative. If you talk to some agents quietly, they are panicking. Right? The reasons they're panicking is because, of course, they are absolutely paid by volumes of transactions actually made, because, of course, it's a commission-based business. And many agents are now, well, frankly, not seeing much in the way of commission coming through. So from a sort of immediate financial situation, there is some panic there, and they're trying to work out what to do. The falls in prices that are being spoken about, and again, a lot of them are very averaged and very generic, aren't necessarily telling the truth on the ground. And this chart, of course, it is really important to understand, because prices, well, they are moving quite fast down. And of course, everybody's been saying, Tarric, that, well, that's okay, because we had a 30% run up or 25% run up from the last 2 or 3 years. So we're just adjusting back down a little. But the real question for me is, at what stage do we get to the point where prices are starting to get to below where they were before the COVID stimulus and the ultra low interest rates? Because that will be a sign, I think, that things are actually definitely looking pretty wobbly. And the third point and final one is, if you look at it in terms of debt to income ratio and debt to GDP, house prices are still massively out of whack.
Yeah, I would agree with that. I mean, Sydney is falling very, very rapidly. To answer just, on that specific market, we've seen prices down now almost 14%. Price falls have moderated somewhat over December and into January, but I think that's January and December, in my analysis that I've done of seasonal data, they tend to be relatively weak months. But I think that's more just a case of weaker on the way up, weaker on the way down, just because there's less volume, there's less activity. As we talked about in our show a couple of weeks ago, we've seen volumes just absolutely collapse. Yep. Well below the 5-year average. And considering that 5-year average includes COVID, the initial COVID, and also the 2017-2019 period where transaction volumes fell due to the Banking Royal Commission and the tightening of credit, we are seeing that sort of boost the market somewhat. But to go back to the first question, I think that we are seeing a relatively orderly fall in terms of the way the market is behaving. People aren't panicking. They're not rushing out to list. They're holding off. That's evident that we're seeing in the volumes of new listings and the volumes of existing listings on the market. And I do think that gives the RBA a bit more headroom to keep rates higher, because there isn't that panic. There isn't that, oh God, we got to do something. And I think it was interesting as well that Edwin posted that open house. I think it was in Kellyville in Sydney, and there's still a line of people absolutely around the block. So I don't think that we're there yet in terms of that panic, in terms of that sort of tightening of activity that you would associate normally with housing prices dropping this rapidly and significantly faster than the US housing crash during the global financial crisis recession.
Yeah, of course, rates have been accelerating very strongly because, of course, the RBA has lifted rates. They probably will lift again in early February. I think at the moment, the real situation is this, that we are seeing some sort of relatively orderly adjustment and correction and taking some of that massive heat out. The interesting question for me, Tarric, will be whether we start to see financial stability issues bubbling up as we start to see more people effectively moving towards default and that putting pressure on the banks. Because that, for me, will be the only reason why the RBA might actually take notice of what's going on. But with everything that I'm seeing at the moment, I don't think it will determine what the RBA does.
At what point do you think that would happen? I mean, obviously it's a relatively, how long is a piece of string sort of question, but, how far do you think prices would have to drop for them to start to get into that sort of, threat to financial stability mode?
Well, it's a good question, because the modelling that I've seen would suggest that if you get something like a 4% real problem in the market, in other words, if 4% of people are having difficulty making their mortgages, that doesn't mean they'll go immediately delinquent, but that's enough to then start putting significant capital pressure on the banks. And of course, it's worth reflecting that in the US, through the global financial crisis, we got up to sort of 12 to 15% of mortgage holders in difficulty. It was a very significant impact and relatively quick, but it took 3 years from the sort of the peak of the problem to actually come through. So there is some room here. And, you could argue, I think, that prices have been driven down because interest rates have gone up very significantly. The RBA will at some point ease off and then sort of keep it and then start to drift down. Now, if people are correct in saying by the end of 2023, the RBA will be on a downward trajectory on price rate setting for prices of money, in other words, cutting the cash rate, then that might be enough to sort of stave off any of this financial stability risk issue. But if in fact rates do stay high, and even if they only come back a little, then I think a lot of pain is embedded in and it's not yet coming through and it's not necessarily that transparent. So it's going to be an interesting sort of game to play, but I think it's going to be months, not weeks, before we start seeing some of this.
Yeah, I tend to agree. I think this is a more long-term issue. I think that people are still, well, they're still not really in the sort of deep trouble that you would think. People can still borrow off friends. They can tap their savings. They can look at all these other different things to buy time. And I think that that's really just the crux of the issue. This isn't all going to happen in a hurry. This is all happening quite slowly, quite deliberately. And just to go back to your point on comparing Australia with the US, is that housing turnover in Australia is a fraction, is about half currently of what it was in the US prior to the financial crisis. Now, obviously, the big number of foreclosures, which peaked at I think about a little over 900,000 foreclosures, and admittedly, although it's a much, much larger market than ours, and that should be very much emphasized, but 900,000 foreclosures, that obviously boosted the number of property transactions that happen in any given year. So, but because Australia's property transaction rate is so low relative to the US and relative to a lot of other places, a much lower proportion of people getting into trouble and then being forced to consider selling could move the market a great deal more than that same proportion of people getting into trouble would in the US or the UK or elsewhere.
That's a very good point, Tarric. And it's interesting also, if you look at New Zealand, the latest stuff from the REINZ, so that's up to the end of December, they've got a 50% rise in inventory.
Really?
Yeah.
I'd only gone through the prices, so that's rather interesting to hear.
So we're seeing a very interesting difference of view, right? Because New Zealand prices are continuing to drive south, and of course rates are expected to go even higher there. So what's interesting is that in the early phase of what the Reserve Bank of New Zealand did, inventory levels fell, and then they started to rise. And they're now, as I say, 50% higher than they were a year ago. So if we start to see a rise in inventory in Australia, then that would be the leading signal, I think, of potential more price falls and significant price falls. If in fact we get away with relatively small increases, then you're probably, looking at it right and thinking, well, it will just sort of wander through. But if we start to see significant rises, and there are some people in my surveys who are actually seriously considering listing now on the argument that prices could fall further and they'd like to try and get out before they fall further, firstly. And then secondly, the other support we have to keep coming back to is Equity Mate, right? Equity Mate is a huge element in all of this.
Yeah, that's something that I was going to ask you about later in the show, but we might as well do it now. Are you continuing to see the number of the proportion of people accessing home equity rising in when they refinance externally in your data?
Absolutely, I am. So I'm seeing considerably increases in refinances. The ABS data showed that the only growth number in the last new lending was actually external refinancing, right? It was up significantly. And I'm seeing it again that a lot of people are pulling equity out of their property as they refinance. So it is definitely the lifeboat that is being deployed at the moment quite considerably. And I'll make the point also that the underwriting standards that some banks are using is they're still using the ones that the previous lender used. So they're not doing a complete new underwriting appraisal, which I think is quite interesting. Let's show you this slide. This is the slide you showed, right?
Yeah, because I mean, this I did for an article a few months ago based on the data that you very gracefully provided me, and basically, we've seen the proportion of people accessing home equity rise to well over a third, and also during that same time that we've seen the proportion of people refinancing, unlocking, getting Equity Mate, we've also seen the number of people refinancing rocket. So I really do wonder what, in terms of total dollar volume, we are seeing people pull out of their homes in terms of cash, because the data that I do have covers up until the end of the 2021 financial year, till July 2021.
Yep.
I don't have any data past that because I've asked for it and no one will give it to me. I've tried, but you can only do so much. But if that was what it was then, what ungodly sum of money is it now? Like it's a really, really interesting question. And I mean, I think that people are probably pulling out less, obviously, per person, because if they were, then basically the entirety of all refinancing would just be home equity. But I think that that's a really interesting question as to, what exactly is going on there, and, how this is potentially insulating people from rising rates. The old rob Peter to pay Paul trick, where you borrow money from the bank in order to top up your mortgage repayments and pay off the bank.
Yeah, absolutely. Well, of course, two observations. One is quite a few people in my surveys are in the $5,000 to $10,000 range of what they're actually pulling out. So they're not pulling out a massive amount, but what they're doing is essentially paying off the credit cards and paying down other debt. It makes sense, basically, because the interest rates on a mortgage are still significantly lower than other, personal credit, particularly credit cards. But they're also doing it to give themselves some runway. Right, because they know, one case I was looking at in some detail was this particular household will reset in June, and they know that their interest rate was due to reset very high in June, so they've decided to refinance now. In fact, they've actually got a bonus by refinancing now because of the differential rate that they locked in previously and what the rate would be now. So they actually got a bonus for refinancing now. They also got a cash payment, because the particular bank they went with actually gave them, I think, about $4,000, $5,000 just to switch.
Wow.
And then they pulled out an extra $5,000 to $10,000. So in the round, they've actually built themselves a $20,000 buffer, right? And interestingly, the rate that they've been able to get was significantly lower than what they would have expected to have got if they'd waited till June. So you can understand the logic. It does make some sort of sense.
Oh, it does. I mean, I guess if I was in their position, I'd probably consider doing the same thing. I mean, you've got that cash there. You can park it in your offset account. It's not really costing you all that much, and you're gradually paying it off over time. So yeah, I mean, it does make a manner of sense. I mean, to be completely honest with you, I've known people that have gone through and just done that again and again and again and again for 15, 20 years. Who just they pay everything on the credit cards, they pay everything on the personal loans, they get themselves into a whole heap of trouble, and then they go, well, my house is worth 150 grand more, so I can just borrow another 20k, and Bob's your uncle.
Yep. Well, the banks still seem very open to it, and I've made the other point. There's very little official statistical data on this very specific question. APRA doesn't really report it, for example.
Yes, I asked APRA. They told me to ask the RBA or Treasury. So I asked the RBA, and they didn't want it. They didn't share. And I asked Treasury, and they didn't share either. So it would be nice to know.
The reason is that it's the ABS who actually collects the underlying data based around what the APRA reporting is. But in the APRA reporting, there isn't anything specifically about equity withdrawals.
No. Well,
that's the problem. Wonder why.
Yeah, no, well, exactly. I mean, do people really want to? I mean, the crazy thing is in 2019-20 financial year, I believe it is the last data that we have for complete household incomes, right? And household incomes at the time are about in aggregate were about a little over 900 billion. And if you look at that and you go, well, all right, let's just extrapolate that, add a little bit on for wages growth, population growth, etc. And then you think about the context of 93 billion being pulled in home equity, something like, I mean, let's just call it ballpark, an additional 10% on top of people's incomes. That is a truly gargantuan sum of money. This is something that is driving the economy, yet we have this really poor understanding of exactly how much it's driving the economy and exactly what it's being spent on.
Absolutely. Well, you said earlier, go granular. This is one case where you really must go granular, and I don't think the regulators want to know the answer.
No, probably not. And we should probably get on to the other questions. Otherwise, we're going to be talking about equity mate all day. Okay. Ash asks, do you think the Fed will give up and revise its inflation target higher to perhaps 3 to 4%? If so, what would it take for that to happen?
Well, it's worth asking, where did the 2% target come from? The answer is nobody knows.
Magic. It's just one of those things, they just decided that 2% sounds like a good thing, and that's what they'll stick with. And I think it makes sense, but I think that the inflation target at that level does give it a fair amount of stability. It does give people, I mean, let me put it this way: 10-year inflation break-evens, which is basically what the bond market expects inflation to be over the next 10 years. They're expecting about 2.1%, 2.2%. Now, if the Fed's target wasn't 2%, I don't think we'd be anywhere near that ballpark. If there wasn't the idea that the Fed would step in to step on inflation. Now, I don't personally think that the Fed is going to raise their inflation target at this point. I don't see it in the foreseeable future over probably the next 5 or 10 years, because it's just they wouldn't want to undermine their credibility any more than they already have.
Have they got any credibility left? That's an interesting question.
Well, they're trying to rebuild it, and good luck to them. But I think it could happen. I think if you saw like a major shock, where if you saw like, I don't know, a major geopolitical event, say something like a civil war in Russia, or a Chinese invasion of Taiwan, or something that completely upset the balance of global trade, completely threw everything out of the window and created huge inflationary pressures, then I think that they could be forced to readjust the inflation target, because depending on how those particular scenarios played out, and the details of them, getting back to 2% at that point might be impossible.
Well, there's two observations. One is, of course, is inflation targeting a sensible way to try and actually implement monetary policy? And what's the relationship between monetary policy and fiscal policy, and how do the two interact, and who's really in charge? I mean, all those are really big picture questions. The second question, of course, is when you say inflation, what's your definition of inflation? How are you measuring it? It's worth highlighting again, as we said before, over the last 20 years, the way that inflation has been measured has been changed. And in every occasion that it's been changed, it's got lower. And in fact, if you look at the shadow stats calculations for inflation in the US at the moment, it's more than 15%. I think I did a quick back of an envelope calculation as to if you calculated inflation in Australia the way it was done 20 years ago, we would be at least at 15% now. So actually, maybe there's a backdoor way of dealing with this, which is, we'll just redefine the way that we calculate inflation again.
Well, that would not surprise me. Let me put it that way.
Yeah.
No, I think that it's an interesting question, and I don't really see any major change in the short term. And we should probably get on to the next question. Okay, Dom asks, how is it that in Australia there are not enough workers but not enough dwellings? Is it land banking, Airbnb, or something else? And KR asks a similar question. I'd love to know how much the rental crunch is actually down to a lack of supply versus supply being held off the market. The 2019 vacancy rate was 2.2% nationally. Then the COVID building boom came, zero immigration, and now we have a 0.9% vacancy rate. What is the impact of household size change?
Yeah, that's a very, very good set of questions. A couple of data points. The census showed that there was well over 1 million vacant properties in Australia when they did the census. And we know that there's been some change in household mix, and I think you've got some slides on that we'll come to in a second. We also know that the number of investment properties available to rent has gone down by about 20% from its peak. And we also know that we've had a rise in migration and a rise in population. The data came out quite recently that migration was very high. And now, of course, Chalmers is talking about, 300,000 this year, right? So, the way to solve the economic problem in Australia is to bring more people into the country. You can therefore never get a recession. Well, not total recession based on GDP, even if you get a recession per capita. So those are some of the sort of the contextuals. Do you want to share that slide now?
Yeah, sure. Well, basically, one of the biggest drivers was that the size of households changed. Now, that's basically just a convoluted way of saying that more people left home, more people left share houses because they wanted their own place, and that was a big factor during the pandemic. And we've got a nice little chart here on the left from realestate.com that shows that the biggest increase was actually in single person households, was of people moving out and to live alone. And there's also, in that particular vein, there's also the fact that during 2021, we saw a rather large surge in the number of divorces. And that's also affected the number of households. Now, the chart on the right is from an RBA analysis that they did on the rental market, on the supply of housing. And they can basically, if you just extrapolate and do the math, by the number of households, by the average household size shrinking, we even before the immigration floodgates were opened, we saw a demand for an additional 400,000 homes. So over basically about a 12 or 18 month period, we went from having a relatively, sort of robust supply of housing and a reasonably good vacancy rate and even relatively flat rents to having this huge problem where there just wasn't enough properties to go around. And unfortunately, that issue has only been further exacerbated. And I've got a slide here on the right here from IFM Economics, which basically shows that the ABS was forced to adjust their population statistics up by 200,000 between October and December. And that is, well, that's impressive, isn't it? The fact that it's been revised up 200,000. So that's another 200,000 people that we need to house. And, we had a tweet here from Justin who talked about this article about someone in Sydney who has a household income of $240,000, yet still can't seem to find a rental property. And I think it's an unfortunate illustration of how challenging things have become in this country. And yeah, well done, Albo.
Well, and just to add a little spice there as well, of course, the Airbnb thing is definitely part of the problem. I know a number of people in my surveys who were offered rental accommodation through COVID because at that stage nobody could use Airbnb. So Airbnb landlords were happy to let their property out for a period of time. And then blow me, as soon as the holiday season started to, percolate up again, all of those people were given notice, and those properties are now back to Airbnb again, specifically in some of the coastal areas and some of those areas also close into some of the cities. So the Airbnb element, I think, is there as well, which is also making it a further complication. Plus, of course, we've now got this next flood of students coming back in to the country. And again, the ABS data recently showed the massive number of student visas that have actually been issued and, the rise in population. So effectively, once we get into the new academic year, there'll be another flood of people looking for accommodation again. So the supply-demand disequilibrium is huge, and this whole thing is broken. And this is, I think, partly Albo's problem, but I'd argue again that this is a long-term structural issue that nobody wants to talk about.
I would agree. I mean, the thing is, I give Albo crap for this, and let's be honest, it's overwhelmingly justified. But Peter Dutton and the Liberals' solution is to bring in even more people.
Correct.
And the Greens' solution is the same. Yep. So there really isn't a major party alternative with someone just going, maybe we should consider what's actually going on the ground with wages, with the availability of housing, with all these different things that are really, really important to the basic, hierarchy of needs. But that's just too hard, isn't it? I mean, if not, you got both Westpac and Commonwealth Bank now basically predicting per capita recessions.
Yep.
And you take immigration out of the equation, well, you'd have a proper recession, wouldn't you?
Absolutely. Well, like I said earlier on, the way to hide a recession is to bring more people in, because then the total activity in the economy goes up. It's just that the activity is including spending more times in traffic queues because the roads don't work very well, and queuing in shops and, queuing wherever, et cetera, and paying ever more of your salary to get a rental in somewhere not particularly salubrious. And of course, the other part of the argument then is, well, we'll just build more houses, right? And that's going to create more activity again. So unfortunately, building more cheap accommodation isn't necessarily a good solution here. And so the supply-demand question and the way that it's being thought through is actually being disaggregated. So the federal guys can blame the states can blame somebody else. It goes on. Nobody's taking accountability for this, and it's probably, for me, one of the biggest holes in the whole story of the future of Australia, and nobody wants to step up and do the holistic thinking here, which is what we need.
Yeah, I agree thoroughly. Okay, next question. Okay. Blake asks, what are the chances that a quick pivot, he's referring here to the RBA cutting rates, doesn't arrest the slide in home prices at the moment? Inflation being the main issue, would a quick cut in rates in 2023 signal that rises have broken down something in the market and do not do much to stimulate demand again?
Again, a great question. I'm going to give you my 2 cents worth, and then see what you think, Tarric. But to my mind, there's 2 questions. Well, the first is rates are going up. When do they stop going up? At the point that they stop going up, do they then stay high, or do they start coming down? And quite a few of the reserve banks and the Fed around the world are saying rates will be higher for longer. And higher for longer means that people are going to be forced to pay a lot more than they've been used to on their mortgage. I don't think we're ever going to see the 0.1% cash rate and therefore a 2% mortgage rate unless something dramatic in the economy breaks. And that would actually be then in the situation of recession or something close. So the chances are we're going to get back to a more, quote, normal, unnormal or normal, depending how you look at it, status in the mortgage market where people are going to have to be thinking of 6%, 7%, and that is going to change the property market, well, probably for a generation.
Yeah, for me, I think that basically the prices are going to keep falling until the RBA is forced to cut rates, because I think that the RBA doesn't have the courage to keep their foot on the brake for long as long as is needed, because we're not going to reach the point where borrowing power and inflation have eaten into the ability to support housing prices before that, because prices are falling rapidly. They're falling faster than during the global financial crisis in the US. But they're not falling so rapidly that we're going to reach that equilibrium with the falls in borrowing power anytime soon. And even in my recent discussions with mortgage brokers and people in the finance sector, that they're telling me that obviously that people's rising costs are eating into people's borrowing power. Yep. That is hitting. It's all well and good for people to go, oh well, I'll just use the HEM, but not everyone uses the HEM is the household expenditure measure, which is basically I'm going to use the word fanciful to be polite, interpretation of how much an average household in certain demographics spends. And but yeah, I don't think, I think that the prices will keep falling, but I think that if we do see rates being cut and the RBA hasn't done something incalculably stupid, like, looking at having like 4% core inflation and then they've gone and cut rates, which is admittedly a highly possible outcome, given that it's the RBA we're talking about. And, that would potentially torch the Australian dollar, depending on the global backdrop under which that occurred. But, it's possible. I've even heard people with, some relatively decent sources talking about that being possible. So, yeah, I mean, that's why I never rule anything out with them. But without some sort of situation like that, where normal central banking is thrown out of the window, rates are only going to be cut if inflation comes down, and if inflation has come down that quickly, something's probably gone wrong. And at that point, as Martin said, it's going to be very much about what the economic backdrop looks like and how that's going to affect the property market, more than how much maybe 1 or 1.5 or 2% worth of rate cuts is going to do. And I don't think that we're going back to 0.1% either. I think, unless something goes relatively, cataclysmically wrong, I see that, maybe in the more distant future, but in the short term, most of the analysis I've seen is talking about, rate cuts of 1.5%, 2%, maybe 2.5% at the outside if things really go pear-shaped. But even that is still different to what we saw in 2020. Hell, it's even different to what we saw pre-COVID. So, 1.5% cash rate is a lot higher than the 0.75 we saw prior to the pandemic.
Yeah, and just bear in mind, of course, that the government has a huge debt problem itself, because of the very large amount of debt that was created through the COVID cycle. And so they're not in a situation where they can do what they did last time around. And of course, the Reserve Bank is struggling with, well, a negative cash flow effectively at the moment because of its bond messing around and paying out the TFFs and things. So there are levers they could pull. TFF Mark II or APRA could come back and say, well, actually, that 3% buffer's that way too much now. We'll drop it again. There are things that they could do to try and actually rescue the property market, but it's all a bit fragile, and I'm not convinced that we're actually going to come to see anything like we saw through that COVID period. I actually think a few people have now, in government and in LBI, have started to realise that actually, if you take rates that low, then you do create a monster.
Yeah, I think that there is some realization of that, but I think we just need to. I think they just really need to just have a discussion about how we're going to extricate ourselves from this situation. You can't have low rates forever. It's distorting the crap out of things. It's driving retirees into riskier and riskier things. And frankly, I mean, it's like we talked about, a couple of weeks ago. It's not positive when you're having, maybe let's call it 20% of a household of aggregate household income being sucked into debt servicing.
Yep.
When in the US it's 8,
yep.
or in the UK it's 9. It's just, I mean, I just say to people, people go, oh, but housing prices, wealth, yada yada blah blah, and it's just like, wouldn't you rather have households paying 50% less of their income as a proportion, not on debt servicing, so they could, I don't know, come to your shop at your business? And I think that's a really sort of key part of the question, without going off on a giant tangential rant as I often do. Just that if you have a business, if you have a job, you are losing. This is affecting you as well. It's not just people who don't have a home, or people who want to buy a home, or people who have issues with housing prices. This is an issue for all of us. This is part of the backdrop of anemic wage growth and crap per capita outcomes. This isn't just a bunch of young people going, we can't afford a property. It's a much, much more deep-seated issue that affects everyone.
I agree with that. And I'd also make the point, of course, this inflation tyranny is disastrous. And, I don't know whether you saw, I think it was the Heritage Foundation in the US did a report where they calculated effectively how much more of people's income was actually being chewed up by inflation in the US. And basically they concluded that about 10% of people's income compared with last year is being chewed up.
Yeah.
So
No, exactly. I mean, the thing is, like, even if we believe the RBA's forecasts of inflation, sort of, what the RBA's forecasts are like, they're Goldilocks. But if you believe the Goldilocks scenario from the RBA, and the fact that wage growth is going to take off, which is part of their scenario, which is, well, it's always part of their scenario. But if you believe that, by the time the fall in real wages in Australia is over, we would have erased the last 15 years of real wage growth.
Yep.
And that at the pre-COVID rate, so we're going to be pushing 2040 before we manage to recover that, if we continue at pre-COVID rates. And that's insane, because the really truly crazy thing is, as I said on Twitter a few days ago, the eight years between 2012 and 2020, just prior to the pandemic, so we're talking March 2012 to March 2020, there was the same amount of real wages growth as there was in 18 months between 1992 and 1993. People say, oh, Australia's fantastic. Look at the wages. Look how well it grows. Bullshit. The wages growth over in Australia over the last 10 years has been abysmal. And if you put it in the context of the 1990s, not going back to like the high inflationary periods of the 70s and the 80s, but just, nice sort of 2%, 2.5% inflation, wages were growing at 5-6%. Yet we've had the most ideal conditions for wages, and possibly in Australian history. Closed borders, huge, $500 billion in stimulus committed, massive rate cuts, and all we've managed to achieve is 3.1% wages growth, which is deeply, deeply negative in real terms.
Yeah, and the other way to think about it is if you look over the last few years and compare the real wages growth with the real returns from corporates. Well, real returns from corporates have gone whoosh, like that, right? Whereas real wages growth have gone backwards. And that tells you something, probably all you need to know, about the structural issues that we have in Australia. So corporates are doing very well. And of course, corporates love cheap labour. Wages growth in real terms is going backwards. That, in a nutshell, is the fundamental problem and the discontinuity we have to address.
Indeed. Okay, next question. Joseph asks if we can expand on what we've been saying about the jobs numbers, about the sample rotation issues.
Hey.
Okay. Now, as you can see from the chart on your screen, the ABS rotates out the groups that they survey for the unemployment and the labour force data. I believe there's 12. Is there 12 groups? I believe, Martin.
Yeah, I think so.
12.
Yeah.
I believe it's 12 groups, 12 or 14. I forget exactly how many. But anyway, the group that was rotated in had an average unemployment rate of 3.8%, whereas the group being rotated out had an average unemployment rate of 3.5% and also a slightly higher participation rate. And I think it's interesting because if you look at the original estimate before the sample rotation had occurred, we would have seen the lowest unemployment rate since comparable records began in the early 1970s. So it's very much, in my view, at this point, an issue of this sample being rotated out and a weak one being rotated in for the fact that we saw jobs being lost. Now, if you look at something, say, like, the ABS job ads in indices, they're still almost double what they were pre-COVID. So I'm also made the point on Twitter that if the ABS unemployment data is reflective of the labor market, then that means that basically all the job ads data that we have from Seek, Indeed, the ABS, the Department of Employment and Workplace Relations is basically completely useless.
Yep.
Because it's completely just crap. So I think that it's overstating labor market weakness. And I will also just add, for the people who've made this point to me on Twitter, that it's also just the fact that maybe that particular group was overstating the true strength of the labor market. So it's not that the labor market has deteriorated. It's just the fact that its strength was overstated in the first place. That is a potential outcome, and I will definitely say that that's a possibility.
Well, that's right. So I made a post yesterday and echoed what you said, Tarric, because we sort of came to it independently, but at the same time, because we always look at these, because actually you need to understand the way that the ABS thing works to be able to actually understand whether it's a material change or not. So there was a material change in the rotation, which more than explained the change in the ABS numbers. But a lot of the mainstream just jumped into it and said, oh, this is a weak number. This will stop the RBA from lifting the cash rate, etc., etc. I'm thinking, no, you've got to look at the numbers. You've got to look at the detail.
Yeah, no, I've had the same thing since July last year, because July, August, September all had sample rotation problems like this, and they all those months understated the strength of the labor market. And then October, November rolled around, and all of a sudden everyone was like, oh wait, no, the labor market's actually still really, really strong. And it's like, well, of course it is. That's what all the other job ads indices say. That's what every other indicator says. How surprising. Yeah. So I think that, like you said, you've got to look into this data, but by the same token, in fairness to the media and to all these other people, I look at even you look at analysts, at labor market analysts, they're not going in. A lot of them aren't going into this data either.
No, they just look at the headline. They probably just read the media release and then go off from there, which of course is not what you need to do. You need to look at the underlying data. Two other points. The first is, of course, the ABS has reduced the size of the sample, whether compared to what they used to do a few years ago, because of the costs of doing it, which I think is quite interesting. And the other, of course, is that there's an issue to do with seasonality, because, of course, we had Christmas and those sorts of things, and very high rates of illness. And so, again, there are other distortions in the numbers, which makes it quite hard to really understand what's going on. I actually concluded in one of my YouTube shorts, just ignore these numbers. They're not going to tell you very much useful at all.
No, unfortunately. But I mean, I understand. I will say the ABS does have a challenging job. They do
Mm.
have their funding cut. They've got
Yep.
all these people looking over their shoulder, and it is a challenging thing. And we'll get on to the next question. James asks the likelihood of an RBA rate hike in February.
Take it to the bank, I would say.
Yeah, I would say that it's pretty likely. I mean, at this point, I would say that it's a 80% plus chance, and I think it would take a fairly sizable surprise in some of the upcoming data releases that we're going to see toward the end of the month. In particular, the quarter. I mean, if we see the quarterly inflation surprise to the downside in a big way, I would be quite
Yep.
surprised, particularly given that some of the more serious inflationary pressures that we've seen recently isn't included in the monthly ABS inflation figure that's currently experimental. So yeah, I would say that it's fairly likely. I mean, even the likes of CBA and the other institutions who are sort of on the more dovish side of things think that it's a fairly likely outcome.
And it's worth saying, I think services CPI will probably be quite strong this time around because, of course, services is very much driven by wages. And if wages is going up, that's going to actually put upward pressure on the CPI.
Indeed. Indeed. Okay. Electrofried asks, I'd be interested to hear from both of you on what your medium and long-term outlook is for Australia's economy.
Yes, outlook stormy. Look, we are blessed in many ways in Australia with our resources sector and our ability to be able to export a whole lot of stuff. And we're also, I think, blessed in many ways because the debt levels we have here from government are relatively low compared with some of the others around the world. So foundationally speaking, we should be in a very strong position. However, my perspective is that we've muffed it over the last 20 years and some fundamental policy errors have been made. And I think it's deliberately driven based off high levels of debt, I guess a neoliberal philosophy that, they've got to leave the markets to run the markets. And it seems to me that we've lost our way in terms of defining what Australia should be in terms of benefits to households and businesses, not just the big end of town. So we have a huge opportunity. We can steer the ship slightly differently. But then the question is, will we, or will we just perpetuate the mistakes of the past 20 years?
Yeah, if I'm to put on my optimist hat for a moment, I think that we could have a very bright future in the medium to long term for Australia. If we can fix the issues with housing sucking in so much capital and so much household income on a regular basis, if we can just get that out of the way and just go back to, just using our money to buy things, to consume, to renovate our properties, to do whatever it is that you want to do, whatever you want to do with your money, rather than giving it to the bank or to the to a real estate agent to pay for a property. Yeah, I think it could be really bright future for Australia, because geopolitical fragmentation is only going to benefit our resources sector, because we are probably the most stable resource producer on the face of the planet. And not only that, but we have a lot of the things that people are going to want in the future. We've got copper, we've got lithium, we've got rare earths, we've got all these different things that are going to be needed to power the transition, to a green economy, that are going to be, which is going to be huge, because next time we do have a big recession, there is going to be this huge push for, green energy, for all these things to use that stimulus funds productively. So I think that there is a really relatively wide path for Australia to have a really positive future, if we do things like, keeping immigration at a level that's consistent with, sort of historical pre GFC levels, at a point where we can help, where we can support the people who come here, where we can provide them with the services, where we can get them the jobs that, that are going to give them that good standard of living, that are, that are going to provide them with the opportunities and the quality of life that we provided so many people with who've come here over the the last more than a century. I think that there is a very bright future if the politicians make the right decisions. Now, whether they're actually going to do that or not is another question, because, even if we do manage to solve the housing issue, or more likely the housing issue solves itself through, higher rates and finally, hopefully killing off loss-making property investing. If we do see that, my concern is that the government's going to do something cataclysmically stupid, like try to reflate the bubble, and then we're going to be right back where we started. But I hope, and I try very hard to be positive that we're going to take a different path, a path that is, less focused on speculation and more focused on actually making things and productivity and just quality of life for everyday Australians.
I agree. And Cameron Murray, of course, keeps talking about the hidden levers of power and the influence of large corporates and other entities, and why it is that policies come out scrambled. And so part of this story is how decisions are made, who has influence, and how do we get more direct influence into the parliamentary system to ensure that better decisions are taken. Because it is in our grasp, the future is generally open, but only if the politicians actually, change tack and do things a bit differently to what they've been doing in the last few years.
Well, this I have a theory. It started out as a bit of a joke, but I do wonder how effective it would be. I call it the politician buyback. Now, if you look at some of the biggest corporates in Australia, some of these, big wig billionaires and stuff who buy political access to the politicians, right? You can buy access to politicians relatively cheaply. You're talking about, $10,000, $20,000, $30,000. Don't get me wrong. It's a lot of money for an individual, but for us collectively, it's cents in the dollar. So maybe we should all get together and start donating to these political parties, and we should do a politician buyback. Instead of share buyback, a politician buyback. So instead of having Twiggy Forrest sitting next to Anthony Albanese at one of these political fundraisers, no. The community raises the money, and we send someone to talk Albo's ear off and give it and make it so incredibly painful and fill every single one of those seats with someone who makes his life a misery every day until he starts acting properly in the interest of the Australian people instead of the corporate donors. Well, I think that might work. Although maybe it's just wishful thinking and taking a joke too far. But we'll see.
You got my vote. Look, we've got to find a way bottoms up of actually more direct influence if this is going to work, right? Because the way that the political system works at the moment, the small number of people in positions of power and the connectivity that they have to the Treasury and the other mandarins, they tend to run the show. And by the way, they're connected to the International World Economic Forum and all that sort of top-down thinking, right? Where is the community bottom-up drivers of change and need? That is where I think the secret. And look, actually, interestingly, of course, Tarric, the internet and the social media and those sorts of things, it's a much more democratic way of actually starting to push. So to my mind, some of the tools that are now available makes it perhaps a little easier to be more influential and to get, as you say, make a bit of a fuss and get in their face. And they need to know that there's 20 to 30 million people around the place who've got an interest in a different future to the one that they actually think they're driving towards.
No, I agree. Okay, Layman Moment asks, why is the Australian economy holding up so well in the face of the housing downturn? Conditions have deteriorated given the rapid change to the cost of servicing debt and fall in credit creation and the flow-on effects to the real economy. Retail and spending and the ASX financials just shrug.
Yes, it is interesting. Of course, the Australian stock market didn't drop as far as the US markets. Mind you, it didn't rise as much previous. But I think you can go right back to resources. The resource sector is such a significant proportion of the economy, and resources stocks have done really well relatively recently. We've also got a lot of financial services stocks, and some of them have done reasonably well as well. So there's a reason why the markets are actually relatively strong at the moment. Then you have to say, well, but how strong are things really? And that's when we go back to what extent is the data telling the full story or not? And then the final point here is timing. it takes time for some of these things to work through. There are a lot of economists associated with some of the larger organizations who tend to have a very specific view of how things are, and a very mainstream view of how things are, and are very late to the party. And I think a lot of the mainstream stuff that's coming on at the moment is partly because they're still not necessarily seeing some of the stuff that's out there, but it's early days.
Yeah, I would say that it's several fold. I think on one hand, it's the fact that people believe that the RBA and the government won't really allow them to get into trouble. So, and if things do go bad, that there'll be some sort of, intervention or bailout or whatever it is that you want to call it, some form of support that stops them from getting into trouble. And I think that a lot of people believe that that precedent was set during COVID. I would also say that a lot of people, so say, for example, there was analysis done by the RBA that said that about, I think it's a little over 50% of people would either see 50% of mortgage holders would barely see their cash flow impacted, their spare cash flow impacted by rising rates. So their free cash flow would drop by under 20%. So there's a very, very large proportion of borrowers who are going to be relatively unimpacted by rising rates, even if they go even higher. So those people have no reason to stop spending, particularly people with these smaller, older mortgages, which make up a majority of people. And in terms of overall mortgage holder numbers, not in terms of dollars, naturally. But I think that there's all these different factors. And I think there's also just the fact that people want to get out there and they want to live their lives. After 2 years being in lockdown, especially for young people who had a deposit, they wanted to buy a house, then they've seen that rise out of their reach and they've just gone, stuff it. I'm going to go overseas. I'm going to drive around Australia. I'm going to do X, Y, and Z, all the things that I've wanted to do because I haven't been able to do them. And that's not only true in Australia. I think that's true around the world. So I think that there is also that changed cultural, that changed, sort of demographic factor that people aren't spending money on the things that they normally would be spending on at these certain ages. Instead, they're going out and they're doing the things that they want to do. Maybe it's restoring a car. Maybe it's, pursuing a new hobby or a new dream that takes them places or whatever. It doesn't really matter. But I think that we are seeing that continue to drive spending, and I think it will keep driving spending. And even if we do see spending moderate, which it eventually will, I'm not entirely certain that that's going to help with the inflationary pressures as much as people think it will, because I think it's really important to keep in mind that retail spending in the US peaked almost 2 years ago.
Yep.
And only now are we seeing goods inflation starting to roll over. And once you also remove the distortion of used cars from that equation, because it is such a huge driver of goods deflation, I'm not exactly sure how much goods deflation there will actually be for us here in Australia. I think it could be a very different change because generally speaking, most inflation in Australia prior to the pandemic was driven by services and not goods.
Yeah, I think that's exactly right, so Tarric. And I think, one again, to highlight the K-shaped economy we have. So we have a lot of people who still are sitting on buffers, are still very willing to spend and able to spend, another group not. And it's that bifurcation between the two, which I think is probably one of the most critical issues that people don't want to talk about, but they should talk about, because unfortunately we've got a significant underclass that are actually not really benefiting from Australia and are really up against it. But then others are actually doing a whole lot better. So we have a very myopic, two-sided story I hear, and net, there are still quite a few people who are doing actually quite well.
No, I agree. And I think we've got time for probably one more set of questions.
Yep.
Okay. All right. There we go. Okay. John asks, how is China's demographics going to play out over the next few years? What will that mean for the Australian economy? They had a population fall last year. Will that continue? Which also feeds into a question that we got from our mate Cookie Boy, who says, when China reopens, will it reignite inflation?
Great questions. The first one on the demographic story, it's going to continue to fall. So it's almost impossible to see how China could turn this around anytime soon. And if you look at the aging of the population in China and the fact they've had this very long legacy of one child policy, and then they upped it slightly, but probably too late. So the trajectory is down. In fact, India is going to overtake China if it hasn't already in terms of the most populous country on the planet. Begs the question, though, doesn't it? What's the future demand for property? What's the future demand from those who have their own property versus those who are investing in property? And of course, how many property investors are losing their shirt because property prices are going down? And will they continue to fall?
Indeed. And I think that the property sector one is an interesting one, because that is really a big part for Australia, because China isn't going to need to keep building infrastructure at this rate forever, particularly with a declining population. So the property sector one is a big question for us, because I just want to just whack that slide up for us, Martin, because Australia is the largest exporter of iron ore on the planet. And not only that, but it exports more than the rest of the entire world combined. And China imports more than the rest of the world combined by a factor of 2 and then some. So Australia very much has a symbiotic relationship with China in that regard. So if the Chinese property sector goes into the doldrums, so will the Australian mining sector in this regard. Because one of the main reasons why Australia hasn't sort of seen too much of an issue from the decline in iron ore prices in relative terms from where they were earlier in 2021 is the war in Ukraine, and the fact that we've seen coal and gas prices go to the moon. But to go back to the original question on the property side of things, new properties in China are overwhelmingly bought by investors. In 2018, about 85% were bought by investors, or at the very least, people who had more than one home, of which is a sizable proportion were likely investors. But so basically, China relies on property prices rising to drive the property sector. But the Chinese government isn't talking about reflating the property sector. They're talking about stabilizing it. They want to stabilize prices. They keep using that word. And that's a problem, because when properties cost up to 46 times household income, you don't want your property to just retain its value. No, you want it to keep rising and rising and rising and rising, because it costs you an arm and a leg to service the debt. So currently, as things stand, the number of people who believe that property prices will rise in China is actually lower than the number of people who think that they will fall. So there's very little incentive for people to buy into Chinese property at the moment. So I think that that's going to be a really key factor going forward, because as the demographics of China deteriorate, and they will continue to deteriorate over time, there's going to be less and less demand for property. And, not to get morbid or anything, but if you think about, the sort of, for want of a better word, average Chinese family, there's, a single individual, they have a wife or a husband, they've got parents, and then they've got grandparents. Now, that's three properties. Sorry, that's 2 properties. There's the grandparents' property and the parents' property that are eventually going to be surplus to requirements. So as the demographics change, as more and more of the older Chinese die off, I mean, obviously the quality of the properties is going to be potentially a rather sizable issue, but that is going to be, a factor that is going to impact the demand for property in China going forward. Now, as for Cookie Boy's question on reigniting inflation, God's honest truth, I don't know. I've been thinking about it. I can think about arguments for, I can think about arguments against. I think that I tend to lean towards that it will. It will obviously be an inflationary pressure to some degree, but to what degree, I'm not sure. But there was an analysis by Bloomberg, which I will be writing an article about probably next week, that they concluded that a base case reopening of the Chinese economy will add 0.9% to global inflation. And if we see China have a little bit of a boom and their economy manages to grow at about 6%, which I don't think can be ruled out, considering the fact that their inflation-adjusted retail sales are 17% below the pre-COVID trend, Well, in that case, global inflationary pressures would be boosted by 1.7%. And well, that basically, if that feeds into the Aussie CPI, you can kiss any chance of any rate cuts over the forward estimates ever occurring in that regard.
Yeah, and quick observation there, of course, China has had significantly strong growth from this construction boom and from the making stuff and selling it abroad. What they're trying to do is pivot towards selling more stuff to Chinese, right, which is a retail story. And you can see it in terms of trying to rebalance the economy. So the question is, will they be able to rebalance? To what extent does that then reduce demand for resources, as you touched on? And will it then actually make them less or reliant on those exports? And so, how different will the economy be in China in that chasing of that economic goal, but also in the light of this big shift in demographics that we're seeing at the moment? So a bit of big questions. And then, of course, if you want to take a more global view, we still don't know what's going to happen with Ukraine, with Europe, and whether the recession is in the US. So there's a lot of factors out there that suggest to me there's a lot of uncertainty into this year. But I'm tending to be with you in terms of saying there's more likely to be an inflationary impulse rather than a deflationary impulse from China if they get their act together.
Yeah, and I would just add that if there is a deflationary impulse out of China, out of the place that's expected to be the driver of this recovery, as the US and Europe and the rest of East Asia goes off the boil. I mean, you've got the South Korean politicians talking about heading into a recession. If the Chinese economy doesn't fire and they don't just jump on it with some stupid stimulus, which admittedly could benefit Australia if they go, just absolutely ham, like they did in 2008. Yeah, sure, that could benefit Australia. But if the Chinese economy fails to fire and they're too concerned about the inflation to really throw the kitchen sink at it, that would be a really, really challenging scenario for the world. Because it means that it's lost its primary growth driver that it has had between sort of 2008 and probably the start up to the start of the pandemic, because the Europe isn't the growth driver. There is a decent growth in Europe, decent growth in the US, but if you take China out of the equation, India is not yet a large enough economy for its growth to power the rest of the world. To power, itself, absolutely, I'm quite bullish on India. But in terms of, taking over as that growth driver for the global economy, it's not there yet.
Well, I've got the view it's unlikely ever to get there, because I think the global model of the way the economy worked over the last 20 years is probably broken and will never be put together the same way again. I think we're going to see more partisanship. We're going to be seeing more of these stresses and strains. I think we're going to see different alliances and alignments as well, which is all going to make it very difficult. But demographically speaking, actually Australia is probably better positioned than almost any other Western economy that I can think of. And that goes right back to what I said earlier on, Maybe Australia is not a bad place to be, although even here, I suspect it'll be a bumpy ride.
Yeah, I imagine it probably will be. And I mean, it just goes back to what we were talking about with the medium and long-term outlooks. If we can manage to fix some of these issues that we have and place the emphasis on things that matter, both economically and socially, I think that Australia can have a pretty bright future, even if we do have a bit of a bumpy time in the meantime. And, I'm quite positive that we can achieve that. And to be honest, considering the fact that I have multiple passports, it's one of the reasons I just haven't buggered off already.
Very good. Tarric, we've gone way over time, but I have to say I think the Q&A session worked very well. So thanks to those who threw the questions in. Really appreciated it. And give us some feedback. Do you like the Q&A format? If you do, we might do a little bit more of it.
Yeah, definitely. I mean, we got through, I'd say, probably most of the questions, but yeah, well, if you guys like it and you guys want us to do it again, sounds good. Yeah, I'm more than keen to do it.
Absolutely. Well, thank you once again. Have a good week, and we'll catch up in a couple of weeks.
Yeah, sounds good, man. I'm looking forward to it.
See ya. Bye-bye.
Bye.